Hey guys, welcome to the third lecture of national income, and today we are going to study methods of measurement of national income. There are three methods to measure our national income. First is output method or product method, second income method, and third one is expenditure method. Now let us study these methods one by one. In today's lecture, we are going to study output method in detail because it's little bit lengthy and hence we'll be able to finish first method only. First one, output method. It is also known as product or inventory method. Now what do we mean by inventory? It's nothing but stocks, product, that's it. Now from the name itself we come to know, in simple words we try to understand first. Output means whatever is the output produced in the economy, in the different sectors of our economy, adding up all those output produced in different sectors of the economy, taking it together, whatever amount we arrive at, that becomes our national income. So if we add up the output, then it is called output method. But there we have to take one precaution while going as per this method is that, see, in economy, in all the different sectors of economy, continuous production is going on. So whenever we add the output, we have to consider only the final amount of goods and services produced. We should not consider the products which are undergoing the production process, otherwise it may lead to double counting. So while using this method we have to be little bit cautious. Okay, let us see how to write the answer. Output method. According to this method, the economy is divided into different sectors such as agriculture, mining, manufacturing, small enterprises, commerce, transport, communication, and other services, etc. Now, while using this method, utmost care is needed, as I told you. So, to avoid this double counting, there are two approaches given for this output method. Now, let us see those two approaches one by one. First is the final goods approach or the final product approach. Now, here from the name itself, we get an idea about the approach. Let us see what it is. According to this approach, value of all the final goods and services produced in all the three sectors of the economy, that is primary sector, secondary sector as well as tertiary sector, all the goods and services produced in all these three sectors are included, and all the intermediate transactions are ignored. Intermediate means, as I told you, all the ongoing production process transactions, they are simply ignored, and here we are adding up only the final product, because see, in the final product already the value of raw material is included. This is but natural, and hence we will directly add up only the value of final product. Now in this, I hope you know about the primary, secondary, tertiary sector, but still in short I will tell you. Primary sector means this agriculture, mining, that is primary sector. Secondary sector means basically it deals with the manufacturing activities. That means converting or transforming the raw material into finished product. That job is undertaken by the secondary sector, and tertiary sector means service sector. I hope you got this point. Whatever is the final output produced in primary, secondary, tertiary sector of our economy, we will add it up and we arrive at the value of national income. This is the final goods approach or the final product approach. Now let us move on to the second approach, that is value added approach. According to this value added approach, the value added at each stage of production is calculated. That means we are starting with the production, we are putting in input, and then we are doing the process, and then some output at every stage we are getting. Because see, final product doesn't get ready all of a sudden. It has to pass through different stages of production. So at each stage, we are considering the difference between the value of final output and input, and then we call it value added approach. We add the amount and that becomes our value added. See, In this value added approach, each stage the value added is calculated by deducting the value of input from the value of output. That means we are considering the value of output, then from it we will deduct the value of input, and then by deducting that value of input we will arrive at value added. Let us make this more clear with the help of simple example of producing shirts. The table I have drawn on the board, please look at the table carefully so that you will understand it very easily. There are 4 columns: production stage, then second one value of output, third one value of input, and then we are considering value added. Let us try to understand this concept clearly with the help of this example. See, production stages for making shirt but natural, first we have to use cotton. So first stage cotton, then from that cotton we are converting it into usable thread, that is strands of fiber, that is called as yarn, yarn, yarn. Then from yarn we are making cloth, then from that cloth we are making finally shirt, which is our final goods. Let us see the amounts one by one. When it was cotton, it's the starting point, so the value of output 150, value of input is 0, so value added is 150, same as that of output. And when this cotton is turned into yarn, that is usable thread, the value of output, that thread value in the market, becomes 250. At that time the value of input was 150, so the difference, that means value added, is 100 rupees. Then the yarn will take the shape of cloth, it will be turned, it will be transformed into cloth, and the cloth value now is 400. And where the value of input, which was earlier one, that was 250, and hence the difference 400 minus 250, it is 150, that is value added, because at the first stage it was 150, that is the value of cotton. Then when we made it to yarn, the value addition done was 100. Now when the yarn it turned into cloth, the value addition is 150, and when the final shirt becomes, the value of output, that means the value of shirt, is 500, minus up till now the value of input is 400, so if we deduct that, the value addition is 100. Now look simply at only the last column, value added, and go on adding 150 plus 100, that becomes 250, plus 150 becomes 400, and plus 100, so we arrive at the final value of shirt, which is 500. If you look at the table carefully, once you listen to this lecture, then after this lecture is over, again go to the table and look at it carefully, you will understand everything. Everything is written clearly on the board. So with this we finish with the value added approach. In this approach nothing is to be done, only from the output we will deduct the input, so that at every stage we will go on adding the value of that final output. This is done so in order to avoid the double counting for the same product. So up till now we finish with output method, in which we have seen 2 alternative approaches. The first was the final goods approach, that is the final product approach, and the second one was the value added approach, which we seen with the help of table. Now let us learn the precautions to be taken while using the output method. What all things to be considered? Number 1, to avoid double counting, only value of final goods and services to be taken. Second, goods used for self-consumption by farmers should be estimated by guesswork. So here we take the imputed value, that means whatever guesswork we have done, that value, imputed value of this farm products, and they are included in the national income to arrive at the correct estimation. Number 3, while evaluating the output, change price level in different years should be considered and adjusted accordingly. Whatever the price changes takes place while calculation, that price change should be adjusted in the final income calculation to arrive at the correct amount. Number 4, value of export should be added because we are getting that, and import should be deducted. So exports added, imports deducted. Number 5, depreciation of capital assets should be deducted. I hope you understand, because Depreciation means we have already used those assets, that is the wear and tear of the asset, and hence it has to be deducted because that much value the asset has lost already. So depreciation deducted. Number 6, sale and purchase of second hand goods should be ignored as it's not a part of current year's production. This is also very simple point. Second hand assets, those are already produced assets which were already calculated in that year of production, and hence they should be totally ignored in this year as they are not part and parcel of this year's current year's production. So second hand assets ignored, second hand goods ignored completely. And now coming to the seventh and the very important point, indirect taxes included in the market prices are to be deducted. Whatever is the market price of a particular product, you must be knowing in the price structure we also include indirect taxes such as GST, VAT, etc. So such indirect taxes should be deducted and subsidies given by the government. See, in case of some products, government do provide subsidy to the product. So such subsidies which are provided by the government to certain products, they should be added back for the accurate estimation of our national income. Now there may be a doubt coming to your mind why it is to be done so. So I have written clearly on the board the reason also. See, minus indirect taxes, that means indirect taxes to be deducted. Why? Because they are transfer of money. See, from the consumer or from the producer, that indirect taxes goes to the government. So it is nothing but transfer of money. And it's not a part of factor payment because taxes are not part of factor payment. What are the factors? Factors of production, land, labor, capital, enterprises. So indirect taxes does not form part of that payment, not form part of the production cost or income, and hence they are to be deducted. Whereas coming to the subsidy side, subsidies by the government, what happens is, because I have written in shortcut, because they reduce the price. Since subsidy is given, the product is shown as the lower price, but actually this subsidy given, it is given by the government, but in reality it is a part of production income, because that when we add up subsidy, then we arrive at the correct value of that particular product. So hence point number 7, indirect taxes deduct, subsidy added. You don't have to give the explanation or reason why it should be added and deducted. That I have given just for your additional information. That's it. Okay. So precautions, in short, I revise. Double counting avoided, self consumption, imputed value added, change in price level considered, export added, import deducted, depreciation deducted, second hand items ignored, minus indirect taxes, add subsidies by the government. So that's it for today. Today we finish with the output method, production method, or inventory method. In next lecture we will be studying income method and expenditure method. I hope you understood this lecture. If it is of help, do like and share this lecture. Please subscribe to my channel. Thanks for watching.